I'm gonna go ahead and start the record button here. But again, we really wanted to talk about kind of how to stay competitive in today's marketplace. And what I really wanted to do is, like I said, use this as an opportunity to kind of mastermind a little bit, because I know what we're doing in our business to kind of try to stay competitive, but that may not work for everybody. And your markets may be a little bit different. So really wanted to kind of use this as an open forum to kind of get ideas and brainstorm on what's working for you, and what are you seeing in your markets, and how people are getting that competitive advantage. And I know we have a couple different professionals here in the group from capital markets side and such. So I'd love to have them chime into this conversation too. But I want to get started with, kind of really where everything starts with, and that's the purchase price. That's our entry price, right? And it's really funny to see how, really about 3-4 years ago in multifamily, when you're looking at OM, every deal would have some type of price guidance on it. It would give you a list price, and that was usually your target that you try to get to. And then we saw this very bullish market, bullish appetite, and then all of a sudden list prices started going away, and then the market started dictating what valuations are. And especially post-COVID, no secret, everybody knows that it seems like every week asset values continue to move and trend up and up and up and up and up. And I know that's really head scratching for people. So let's kind of start there. When it comes to entry price, I hear this so often, well, God, I just can't make sense of that valuation, or how are people getting to these numbers? Anybody have any thoughts around what you're seeing as far as the asset values in your respective markets? Anybody?
Hey, I'll jump in, Cody. So hey everyone, I think I met a lot of you, but if I didn't, I'm Tony Castanuva, based in Houston. Cody, I think that what we're starting to see is the impact of the debt structure impacting purchase price. We still have a lot of zealous sellers who are pricing to a point where it doesn't make sense to underwrite for those purchase prices anymore. Not with the kind of debt that's out there. It's probably still lagging a little bit. And I think that I'm expecting some of those sellers to see softer offers coming through. So we're just being real with it, and we're still sticking to our underwriting principles, but hopefully in the next few months, we start seeing something more realistic coming through.
So Tony, to that point, what type of feedback are you giving when you're presenting feedback to the broker, for example, especially regarding the capital markets and some of the tightening that we're seeing? What type of feedback are you giving, and what are their responses?
I mean, there's always, potential to find a deal where you can assume something that has good terms, right? That you might want to assume. But if you got to put new debt on it, and especially if it's bridge debt, right now, I mean, we're looking at longer terms on that bridge, where maybe we might have come in more aggressive and think that we can reposition in, say, 24 months and refi into a long-term, agency type product. Now we're thinking, we're still going to be going up on rates. And if we start looking at having to exit that bridge in 24 months, it's a dangerous place to be. So we're looking for longer bridges in those situations. And of course we can purchase, rate caps and things like that. But, we're just having to put that type of structure together. And that's, something that every broker should understand when we're underwriting, that, we can't come in with super aggressive debt structures anymore.
So we got a couple comments on that, Tony, but before we get to there, I want to hear from some of our capital markets guys. We got two of them here in the room. Let's have them chime in. Kiva, Jack, you guys want to touch base on that and kind of tell us where the capital markets landscape is right now?
Sure. The truth is, I'm with Tony, and I'm wondering how long is it going to take till the prices come down. I have the issue day in, day out. We always have the issue. We do find there are some people that get going down a little bit. Deals that came in a little higher rates now, just a month ago, and now they're sending in lower offers, and people are considering them. Bridge, be honest, you're going to the bridge now, especially without a cap. It is nerve-wracking. And I don't know what to tell people, get a cap. It is nerve wracking. It really is. A lot of my clients are just looking right now to get, cash flowing, just get the regular fixed rates right now. I know a lot of banks, lenders that we have, especially, in New York City. I just met with one of the lenders. They said they're starting to require that you have to get a cap rate. I mean, some lenders require that already, but not all of them, but they're like getting into it. They're everyone's expecting it to just keep on rising.
Yeah. Jack, you got any input there?
Yeah, if you're working with clients that aren't buying rate caps, they're a lot braver than what I've seen. The issue we've been seeing is the cost of those caps. I was talking with one group last week, and within a week of purchasing the cap, it went from $400,000 to $525,000 on a 2-year cap, not even a 3-year. So those costs have blown out, and obviously depends on the notional value. Common thing, I think I've started to already hear it from different groups this past week that, the BLVs that came in a couple months ago, those sellers just aren't probably going to be getting those prices. And I was talking with the group yesterday that was, was going to put in a bid for 26 million, and the whisper was 32 million. And so they're, 20% off price guidance. And they're just saying, we don't want to be disrespectful with this LOIs. It's in the ballpark, and the brokers seem to think that it wasn't. But we've started to see some of those whispers where before it was whisper was the starting point, and then rounds of offers would go up and up. Now it seems like the whispers are almost the high water mark that brokers are going for. But obviously case by case to some degree.
Awesome. Appreciate that input. Hey, Jack, Akiva, go ahead and introduce yourselves, if you don't mind, to the group here for those who aren't familiar with you guys and your respective brokerages. Jack, go ahead real quick.
Yeah, so I'm Jack Harder. I work with Berkadia. I'm out of Orange County, California. Berkadia is a nationwide lender doing, agency, Fannie Freddie, life company, bridge, debt fund, CMBS, the whole deal. And also some more structured finance with preferred equity and equity solutions.
Akiva, go ahead, man.
Okay, so I'm working with Meridian Capital. I'm sure most guys are familiar with them, group based out of New York City. So I'm from New Jersey. I work in New Jersey office, Woodbridge. I would stop in New York a lot, work between those two offices. Focusing right now in Texas. A lot of my clients left the city, New York City, during COVID. It got, it was wild. So they went, relocated in Texas. Focusing a lot we have some New York based lenders, fixed rates, balance sheet lenders, very aggressive. That's where, my main focus is right now.
Awesome.
In Texas.
Yeah, both great brokerages there, and both great guys to connect with. For anybody who's looking for a lender partner, definitely would recommend getting with these two gentlemen. Awesome people to network with. And so, it's a really relevant topic right now, because the other question is to Tony's point is, we can't do anything without debt, right? The debt is our biggest equity partner in the deal. And, it's interesting to see how the debt market really hasn't seized up at all, at least from what we've seen. We haven't seen a whole lot of tightening yet from our perspective, at least in our markets. But I think you have to really look at this as a macroeconomic scale, right? Like really what is driving the aggression that we're seeing in the marketplace. And you have multiple different factors in there, and it's a whole nother topic for a whole nother presentation. But, we have a significant supply demand imbalance. You have these very robust migratory patterns. Akiva, you mentioned it, right? People coming from New York, people coming from California into areas like Texas, Florida, the Sun Belt, things like that. You have, on a global economic scale, you have the US bond market that's still the positive yielding bond market as compared to all of our other industrialized economies. I think the German bond just finally got above the zero rate, if I'm not mistaken. I think it was 25 bips when I saw it the other day or something like that. So, but the point being is that the American bond market is still the most attractive bond market when you look at the global scale. And so you still have a lot of foreign capital coming into the US market looking for opportunities like commercial real estate. So I think it's an interesting dynamic. Obviously, nobody has the crystal ball. I wish we did, but I kind of take a little bit of a antagonistic approach or thesis here, where I actually think that there's still a lot of tailwinds in our sales for commercial real estate. Now, to the point of rising interest rates, do I think it'll slow the appetite down some? I do think it will. Maybe later towards Q3, Q4 this year, especially if the Fed does continue to push rates as aggressively as they're anticipating. But really, I think for especially the experienced borrowers, especially the operators that have large portfolios, they've kind of been through similar cycles, or they know the fluctuations in the rate market and things like that, and they're in a better position to hedge their portfolios and be able to weather this storm. And as you guys mentioned, we have things like rate caps that we can buy down, or hedge against that rising cost. Now, it is insanely expensive, and it happened to us on our rate cap on our last deal we just closed on. Tony's a partner in that one. Our rate cap went up 50% in a matter of just a few weeks. And when we close it, thank God we closed it when we did, because it doubled after we closed. So it's all about timing. But I think when it comes to like your entry price, I think really keeping your finger on the pulse and really staying in tune to where the capital markets are, and really working with the opportunity and the underlying fundamentals to really understand, what is driving that purchase price, what's driving that demand. And like I said, in areas like Central Texas, we're seeing record amount of absorption rate. Houston, for example, ranked 3rd or 4th in the country last year for, see you later, Tony. Thanks for stopping by. Houston was ranked number 4th, I think, in the country for absorption. We absorbed almost 38,000 apartment units last year, and we only delivered 15,000. And so it just goes to show you just the supply and demand dislocation. And so that is fueling the purchase price. So for us, what we're doing is we're really trying to work with the investment sales guys, the brokers, to really figure out, okay, this is the value that or the price guidance that you're giving us. How do we get creative enough in finding value to make sense of that valuation? And if we can't, then we walk away. And I would argue 8 out of the 10 deals that we see end up doing that. We just end up walking away. But there are a few that you can really see the underlying factors. Again, the absorption rates, the supply constraints, and things like that are really driving those factors. So unfortunately, the reality is the brokers, until things do slow down a little bit more, you got to find a way to get creative in creating that value to get to those purchase prices, or other guys, especially bigger shops, are going to be coming in and scooping these deals up. So one of the other things that is really on the top of everybody's mind right now is, especially on the risk capital or earnest money, is substantial hard money now being offered. And that's become the industry standard, right? Again, 3 years ago, we saw the introduction of hard money, and it was just a small amount. And then it became more, and it kept pushing the needle. And now you're seeing, hard money and risk capital in excess of $500,000 to $1 million, sometimes even more than that, going hard day one. And so for those of you who aren't familiar with what that means, that is non-refundable earnest money that's put up in your offer that goes non-refundable the second you sign a PSA, for example. You put up $1 million hard, you sign the PSA, and unless the seller has some type of fraudulent activity or misinformation, that's $1 million that you may never see again if the deal doesn't close. And so it is a huge risk, and it is a huge burden on a sponsorship team, but that is unfortunately the landscape we're in and how sponsors are winning deals. So is anybody having challenges with being or losing opportunities from people that are putting up earnest money? Anybody? I'll give you an example. We were just investing final on a deal here in Houston last week, and we went through our buyer interview, and we were right there at the finish line. And then, excuse me, my daughter's here. Oh, look how beautiful. That's sorry, my daughter got a new PJ set, and she was really excited. So hashtag dad life. So. But anyway, so we went through the buyer interview, and another buyer came in and put up $5 million worth of risk capital up front. Largest earnest money that we've lost out to that we're familiar with. And, there's just nothing that we can do with that at our level. Right. And But the reality is guys, if you're looking to be competitive and you're looking to stay competitive in this marketplace, you got to get uncomfortable with being, or you got to get comfortable with being uncomfortable. You know, you got to put your neck out there a little bit, and you got to be willing to put up some risk capital really to even be considered on some of these offers, you know. And I know that's a hard pill for a lot of people to swallow, but it took us a little while to adjust to that in the market. You know, we lost a lot of deals last year because we weren't willing to kind of put ourselves out there. But you know, we had to accept that fact, and you know, now we're playing the game, so to speak. But anybody else have any thoughts or any opinions on you know, what they're seeing as far as risk capital?
I just had a buyer the other day. He just called me up. A smaller deal in New Jersey. He wanted, seller wanted him to go hard on day one. And he was like asking me, like, could you guarantee me that I'm not gonna lose the money? I'm like, that's one thing I can do. I tell you what I see. But I think what I imagine I could get you the best, you know, speak to the bankers before and get you in the right spot, but I can't guarantee anything. You got to be aggressive at times, you know?
Yeah, for sure. Absolutely. Yeah, there's no guarantee, and that's the risk you're taking. You know, that is, and I would argue that if you're going to take that risk, you really need to have an experienced sponsor on your team. You know, have somebody that has the experience to really partner with you and be a guide and a mentor for you that can tell you, like, hey, if this makes sense or not. You know, you're seeing a lot of shops come in buying deals with these crazy earnest money checks because they understand the significance or the power of the deal, right? Or the location of the deal, the quality of the deal. They understand the economics behind the deal. And so research is your friend. Understanding your markets is obviously your friend, but you know, if you want to have that competitive advantage, you have to have somebody that's experienced on your team to definitely be there. So, you know, one other challenge that we've seen, or one other area that we've seen it as an opportunity to be competitive, is on our inspection periods, our feasibility periods. You know, historically, typical offer would have a 30-day due diligence period, 30-day escrow, and then, you know, maybe an extension. And now we're seeing, you know, you're having to go as tight as maybe a 10-day window for feasibility period. And for those, again, who are not familiar with that, that's the amount of time that's allocated to conduct all of your due diligence, your physical due diligence, your file audits, all of the things, your lease audits, et cetera, to determine if there's any red flags that would be a barrier to you acquiring this deal, right? And so, you know, I would tell you that you don't really need 30 days to do a full due diligence, especially on a small to mid-size multifamily property. You definitely don't need that, but you know, you have to get really comfortable tightening those timeframes up. So anybody else on the call, any suggestions on what you're seeing as far as inspection periods or that you're doing? No? Uh-oh. Am I boring everybody to death already? Well, I'll tell you, one thing that we're doing is we're going in, especially at our best and final offer, we're going in as little as 10 business days on our inspection periods. And the key to that and the confidence behind that is really having a good property management team or a good third-party team that can conduct a very thorough due diligence for you. And one thing that we do ask for sellers that I think that most sellers are very amenable to is giving what we call an early access period, which is while we're negotiating the LOI and moving to PSA, we have access, full access to the property to get in, conduct our due diligence ahead of time before signing the PSA. And with a good due diligence team, a good property management team that has those capabilities, you can really conduct a very thorough due diligence in a matter of just a few short days. And if anything, give you enough indication as whether there's any red flags that you need to be aware of before you execute that PSA. So, you know, that's one area that people can look at as far as kind of being more competitive on your terms. And so we still do a traditional 30-day escrow, but we will also ask for a 30-day extension on that escrow period, because as Kiva, Jack, you guys know, right? Third-party reports right now are getting so delayed. I mean, you're seeing what I know in our market, sometimes 4 weeks to get an appraisal back. And such. So you guys have any input as far as what you're seeing as far as third-party reports?
I think 3 to 4 weeks is kind of the norm now. Before I used to get it, you know, rushed or, you know, shorter turnaround, but yeah, it's still kind of that timeline at this point.
Yeah. Yeah, I agree with that. And we're, there's multiple different third-party reports that come in, right? Your phase one, your condition reports, things like that. But we're seeing significant delays. So the lenders are even requiring more time to close. And so definitely asking for those escrow periods. And look, I think multifamily owners today, most of them are buyers themselves too. So they know how this works. So most of them have, at least I haven't seen any kickback on getting a 30-day extension as needed. Now, usually that coincides with more earnest money going within each extension. But that's something to look at. So it shortens your time frame. If you do a 10-day feasibility period, 30-day escrow with a 38-day extension, you're still looking at close to 90 days to close the deal, which is pretty typical in line with where we see transactions close. So any thoughts, comments there before we move on?
We've seen any sellers kind of have pushback on access agreements prior to a signed PSA?
Not pushing back, but we have seen offers come in where they've waived their feasibility period altogether, and we've lost out. So it's not necessarily the sellers that are pushing back; it's just that other groups are willing to come in and take on that risk. So now we're not seeing that often in like your value add space. What we're seeing that more is your core product. Your newer product that you don't expect to find anything significant on your physical due diligence. So, but yeah, we've seen that on several occasions. So, yeah. And again, that's one that, look, this is really ultimately up to your risk tolerance, right? And for us, we got to at least know what we're getting into before we're writing you a $500,000 or $1 million check, So, and guys that can come in there and take that risk burden on, I think those again are probably larger operations, could be institutional buyers, family offices that have the financial means to kind of back that decision. And if they lose that, it's a drop in the hat for them. So, don't try to bang your head up and trying to compete with some of those guys. Yeah, would be my vote. But awesome. Well, the next topic I wanted to bring up, and the next way that we're looking at being competitive is on our broker relations. And this may seem kind of rudimentary, but I think there's historically been this kind of disconnect between buyer and broker relationship, right? Where the buyers typically look at the brokers as your enemy in these transactions versus really working with them and working alongside them to figure out, hey, how do we make this a successful transaction? And that's what the brokers are really looking for, right? They're looking for surety of close. They're looking for a good, credible buyer that to get the transaction done. But they're also looking for somebody who's willing to work with them to try to make this an opportunity, right? Deals aren't found, they're created. If you've ever heard that term before. And so I think really leaning in on your broker relations is going to be important. And I'm not talking about just taking brokers out to lunch and having a coffee, hey, tell me about your family. I'm talking about being genuine in kind of understanding where the broker's pro forma is and where do they see the value being created? How does that equate to the market? Is this a trend or value add that we're seeing in the marketplace with other comps in the area? Or is this truly a need in the marketplace, for example? And really working with them to kind of culminate a plan and a thesis around or consensus around that valuation. So any thoughts to there? Anybody that's worked with brokers? Alex, I know you met with a broker yesterday. What was that conversation like? And have you put any offers out yet?
No, not yet. We went to take a look at it. He showed us the rooms that are already, or the units that are already renovated. And it just seems like, I've talked to him through a Zoom call before. So this time when we met up with him, it was more of a casual conversation about it. And he's got 2 other offers that are going to be, released soon as well. And he just texted me the address of those 2 places. So, and I'm having lunch with another broker tomorrow, and I'm in Reno, Nevada. So, we'll see how that goes. It's our first kind of face-to-face. He's got, we talked a little bit about personal lives and what he's done and overall. So I was just trying to make that connection, you know?
Yeah, absolutely. It's important, man. You have to be authentic. You have to be relatable. You have to be somebody that the broker wants to talk to and wants to work with. That's key. But one other thing that we found to be an advantage for us is every single time that we go through the exercise of going through LOI, best and final, we've been through enough of them now. Every single time that we get to those stages and we don't get the opportunity, we always ask the question about, hey, where did we miss out on, right? Where were the opportunities that we could have improved on to come in with a better offer for the next opportunity, right? And I find that to be a very receptive conversation when the brokers are asked that, because they can give you tangible feedback. They could tell you, hey, you weren't aggressive enough on pricing, or hey, you didn't put up enough earnest money, whatever. And they can really be a guide for you in helping you, excuse me, in helping you determine how do you be more competitive? How do you get that competitive edge for the next one? And, that's really what helped us get through our barrier last year when we kept coming up against challenges of, not being able to get out of our own way and put up that risk capital we needed to give ourselves an edge. It took enough of those conversations and enough of that feedback for us to really be able to push through, excuse me, and get through that. And so I think giving broker feedback is so critical as well when you're underwriting a deal and you're analyzing a deal, not just saying, hey, this deal doesn't work, we're on to the next one or whatever. Give the broker tangible feedback, give them reasons why you can't come up with that valuation, and show them and talk through articulately why you can't come to that valuation. And most often you'll find a very positive response from that. They may not agree with you, but they'll find that really strong, because what they're doing is they're learning your thesis. They're learning your, how are you executing? How are you thinking about these opportunities and whatnot? And that's a great way to build on those relationships and getting you to those next opportunities. Now, look, a broker, when you get to best and final, they're not going to tell you, hey, come in at this purchase price. They can't do that. But what they may be able to do is give you a little bit more guidance as far as, hey, look, I think you need to be a little bit more aggressive on risk capital. You need to be a little bit more aggressive on pricing and things like that. And that's how you can kind of give yourself a little bit more of an edge when you get in those opportunities. So broker relations is absolutely important.
The one that we met, now let me know what you think of this. Is since it's the first time we met him, he told us that his wife is having a baby in 2 months. And what my wife and I thought about is sending him like a care package, because it's the first one of, maybe it's like a little gift, some, chew toy, like the giraffe. What is that giraffe called that every baby has? Sophie, I think, something like that. And just to keep us in his mind, he has hopefully some off-market deals,
Yeah, look, I think anything like that just shows that you're being thoughtful and intentful. And I think that in general, that would probably resonate very well. The thing is, it just can't stop there, right? There still needs to be follow-up. So what I would recommend that you do is to extend that further. Make sure that you're dropping them into your CRM. Make sure that you're taking that notes that, hey, the broker has a delivery at this date. It's a boy or girl or whatever. So that way in future conversations, when you're going on future tours, or maybe you're connecting for lunch, you can bring it up. Hey, how's the baby? How's mama feeling? Whatever. Like, you can use that as a way to relate to them on a personal level, ongoing. And that's how you build more organic conversations too. So, but I think that's a great idea, and I think that's something that would definitely help you stand out. So, but cool. Well, the last thing that this is a common thing that I'm hearing very often is you're hearing a lot of people, because of the level of competition, especially in your primary markets across in the Southeast here where we're located, is people trying to migrate more towards secondary markets. You're hearing this more. I'm going to go in secondary, tertiary markets where you may find less competition. And this is one that we actually, a thesis that we don't really necessarily agree with, only because, number one, I still think that you're seeing an incredible amount of competition in secondary, tertiary markets, especially in your desirable states like Texas, Florida, things like that, North Carolina. I think Alex, Reno, Las Vegas is very similar. So those markets, you're seeing a high level demand in those areas. So you're seeing, I mean, we lost out on a deal 2 years ago in a tertiary market to an institutional buyer on a deal that an institutional buyer would never historically have even been considering. So, competition is still out there. You're still paying a premium. You're still seeing cap rate compression in your secondary, tertiary markets. Maybe not quite to the extreme that you are in primary markets, but it's still a premium that you're paying. And there's some execution risk that comes along with the market, especially if there's a downturn. Your secondary, tertiary markets, especially that are dependent on one, maybe two economic drivers. If that industry is impacted by a recession or a downturn, it could really impact your operations. And so I know a lot of people are looking for opportunities in those areas, but and that could give you an edge if you're, we're in best and final, we're competing against, now it's 10 in the best and final. So there's a best and final, then there's a final, and then there's another final before you actually get to the deal awarded. So you might not find that as competitive pool in the secondary, tertiary markets, but I would argue there's still a lot of competition there. So anybody looking in secondary markets now and having any luck? No.
One of the things that the broker told me today is we were asking him about, the housing shortage. That's something we've been hearing in Reno. And he says, they just had a meeting, and based on the permits that people are pulling, he gets this notification. This is the first time I've heard about it, where every time a permit gets pulled, like it's approved, he gets a notification. And he's like, well, every time that happens, that means someone's building something. And he says that anything that's 40 units or more, he says usually takes at least 2 years to become from the time they approve it to the time that it's available. So he says up to this point, he says for the next 2 years, we're only at about 30% of what the market is demanding. So home prices are going to continue to go up, the pro forma. So he's like, definitely, he's an investor himself on GPs. And he's like, we're definitely still buying on pro formas. I mean, that's what he's saying. Is there a legitimacy to what he's saying? I don't know. Or is that every market's different? Can you trust that?
Yeah, no, I think, looking at permits pulled are definitely an indication of what the development pipeline looks like in that area, which is where does development come from? It comes from demand, right? And so I think it is something that is a good metric to track and follow. And really, where is the demand coming from? Is it another employer coming in, Amazon, for example? Is it that the Tesla is moving to Austin, whatever it is? Looking at factors like that, what are the drivers that are, forcing these permits to be pulled, and what type of development's coming in? I definitely think it's a metric you should follow, and it could give you an advantage in a particular market that maybe that's not on everybody's radar right now, for sure. But I want to to that point, Akiva, Jack, what are you guys seeing as far as the lender appetite in secondary, tertiary markets right now? Any difference from primary markets, or any comments?
I've lost a couple of deals with my lenders and secondary markets where the banks didn't have the same appetite as the regular markets. I'm having that lately. I mean, they just weren't as aggressive as I want them to be. That's where
Yeah, I think it gets priced in sometimes on different. I guess you're looking at bridge or debt funds. Was looking at one in South Texas, very South Texas, and that kind of got priced in. Some groups just passed based on market size. They said it's too small, or wasn't a fit for them. So I think it does thin out your lender pool sometimes. I wish I could say Fannie and Freddie were more aggressive leverage wise on underwriting today, because they have historically been the ones that Freddie Mac will go to those underserved markets in those secondary, tertiary markets. So I think for the current financing environment, it does get priced in, and it's possibly a little bit more expensive. And some groups kind of thin out once you get into those markets.
Yeah, Yeah, I think we've seen similar, like I said, we don't look in secondary, tertiary markets, but we've seen or heard similar things from other operators, other borrowers, other potential lending partners that are kind of seeing the same thing. I mean, look, guys, if I can emphasize this enough, your capital markets partners, your lenders are going to be your best friend in these deals. They're going to be your biggest capital partners. And typically your capital markets guys are going to be the ones that really know where the market's going. And you'll start seeing adjustments in the capital markets before you'll see trends or changes in the actual markets themselves. So if the lenders are tightening up or if the lenders pulling back on leverage, if spreads are widening, whatever the case may be, there's usually a reason why. They're trying to hedge against their risk, or they're seeing a little bit more risk than what they probably want to. So anyway, that's something to keep in mind. And that's why the last part of this, I would tell you, as far as a competitive advantage, is find a good lender, find a good lender broker. Jack, Akiva, these two guys here that really can help you not only really evaluate the opportunity to look at from an economic standpoint, but really look at other market dynamics to really see like, hey, can this thing really make sense from a debt perspective? Jack, Akiva, would you guys agree on that?
100%. So you wouldn't look at a deal in a secondary market? You wouldn't even take a look at it?
Never say never. I've learned every time I've said I'll never do something, I've always ended up doing what I said. No, I think it's about proximity. And this is something else that people need to be very cautious of. Look, if you're going to, a very tertiary market that has a very small population that is in the middle of nowhere, no proximity to any other MSA, that's your highest risk exposure. But if I'm looking at a secondary market that's maybe 30 minutes outside of San Antonio, I can feel pretty good about that market knowing that it's in proximity to a very densely populated MSA that has good economic drivers. That's a different scenario. So to that example, we would look at secondary markets in and around those areas. We just won't go anything outside of, let's say, 30, 45 minute radius from a major MSA. Or let me say, we don't look for those opportunities. I'll say that. So.
Well, yeah, I'd also say along that your largest partner, vet. I would say sometimes you got to vet things up front, even with them, making sure that there's no, underwriting stress tests, that banks might have, that they maybe not that they're hiding it, but they're not, forthright saying, this could come back and reduce proceeds. We had that come across on one deal where the appraisal came in, at where we were underwriting, in place, but they were going off kind of pro forma numbers, and all of a sudden the bank cut proceeds by 10, 15%, and they were scrambling. So, a lot of banks will have those underwriting stress tests, at different rates, amortizing rates, and, have to account for those on where you will actually deliver that loan.
Sure. Absolutely. Well, anybody else have anything else that like you said, that maybe you're seeing that's working in your markets, that maybe giving you a slight competitive advantage? Any other, barriers that maybe you're seeing that you're looking for help with?
Can I ask a question?
Please.
For Jack and Akiva, is it okay, say if we get this deal and all the T12s rent roll in Reno, Nevada, and sit down and have a chat with you guys to see, hey, do these numbers even make sense? Does it even make sense to go after something like this? Can we even get lending? That was one of the conversations my wife and I were having. I was like, the debt service coverage ratio might be a little low. Is that even is it possible to even go into this? Are you guys open to that?
Sure. I mean, we do that all the time. I get that.
Okay. I wasn't sure because I'm so new at this. I'm like, is there?
I just got 2 Texas deals and 2 large, not great. I'm 50 million, two of them in, running it through before they send in their LOI they want to see if it makes sense. We could get a feel where they're holding. Sometimes we make not even a soft quote. We just bring it to some lenders and discuss it with them and see, what they think about it.
Yeah, I think that's kind of one of the like Cody said, have a good mortgage banker on your side, because what we like to do, it sounds like Akiva likewise, is get involved early, and before you're even submitting an offer, send it up, because if you submit an offer but don't know where the financing is, that could change a lot down the road.
Right.
Making sure getting it vetted with your debt guy, and they'll should run the numbers, like Akiva said, kind of put together some soft quotes and, size up the deal and say, okay, this is where we think this will shake out, obviously subject to, appraisal and things down the line. But yeah, definitely running those numbers early on, letting you know what the actual leverage that we think we can achieve.
Oh, that's awesome. Thank you guys so much in advance.
What they both said, Alex, is use them and abuse them for sure.
That's it. This is a service business.
Yeah. Oh,
So
man.
someone told me, having these conversations, like no one can waste my time except for me. So a lot of guys are saying, we don't want to spin your wheels or something. Well, you can't. This is what we're here for. And it's,
yeah. Because it's so new to me. I wasn't sure if is that an okay, acceptable thing to do?
I mean, actually, quite the contrary. I know to tell somebody's like a real client, somebody that checks them beforehand and all deals, he runs it through me and I see where they're at. Sometimes it can take a long time till we actually, work together versus I have a guy that's like, oh, he's under contract, sends me in the deal, he wants to close. And I know right away something is like, this guy sent it out to, I don't know, he's just trying to shop around the deal and he's not like so serious about it. I like to see when somebody's serious and they want to make sure, we're see what they could get beforehand and what's, what's out there.
Yeah.
Right.
Touch base with them. We do it all the time.
Yeah. And you really learn a lot through that, Alex. You by talking with those guys and having those conversations and going through the exercises of underwriting, comparing it to how they're sizing it up on the debt side. That's where you really learn a lot about, hey, how are the lenders looking at this? Because ultimately they're going to be the ones lending you on, lending the capital on it. So if there's not an alignment there, the deal has no chance, or you're putting yourself in a very risky position. So you're going to learn a lot through, keeping that open line of communication relationship with them. So, and by the way, they have resources at their disposal that you don't have at your disposal, things like, in-depth market analysis. I know, a couple of groups that have proprietary data packages that they put together that can really give you a lot more detailed insight than what you can go pull on your own. So, lean into those guys very, very heavily. So,
oh, that's so good.
Awesome.
That's this call right here. That's money right here.
Yes.
Cody's like, I'm going to start charging for this.
No, hey man, that's what this is about, guys. Look, we're all here to, bring a group of community together. And that's why I really like this kind of format, this really organic kind of masterminding session, because this is where problems get solved. This is where barriers get broken down. And this is where people grow their businesses. So that's what this is about. So I really hope you guys found it valuable. Just as a recap for tonight's discussion, we talk about how do you be competitive? Number one, you got to figure out a way to find value and create value to get to purchase price. That's number one. You have to start at purchase price and you got to find a way to get there. If you can't, then walk away. Number two, you got to have some risk capital up front. You got to get comfortable with putting up some risk capital if you're going to be in consideration. Figure out what that means to you, if you want to play in that ball game or not, but that is the reality. You got to have some risk capital up front. Shorter inspection periods and shorter terms on your closing deadlines is going to be work in your favor, and buyers or sellers are going to be very sensitive to that. So look for advantages and opportunities to shorten those periods. Work with your property management team, work with your third party to see if you can really drill down and get very intentful in your due diligence periods to really give yourself more competitive advantage. Ask for feasibility periods in exchange, but figure out a way to really get those closing timelines down to give that seller a little bit more confidence that you can get this deal executed. Again, if you're looking for opportunities outside of primary markets, going into secondary, tertiary markets might open a few more doors. I just caution you to approach that with caution. Be aware of your execution risk when you're doing that. And then, like I said, make sure that you have a great relationship and great partnership with both your investment sales brokers and your debt brokers, and really lean in heavily on those relationships. So with that, guys, I want to thank everybody for being here tonight. I really hope you found this valuable. I have this recorded, so we'll be sending this link out. For those of you who didn't catch the beginning, we are changing the brand of the meetup to Apartment Educators. So you'll see a new title come out through our social media blast and our email blast. So don't be alarmed when you see that, but that will be apartment educators for Houston. So you'll see that. Would love to connect with you there. I hope to see you guys back next month, and feel free to reach out to us. And if you ever need any help with anything, we'd love to add value to you. I did drop my contact information in the chat earlier, so make sure to go back and read that. But with that, I hope everybody has a great night. Thank y'all so much for tuning in. Great conversation.
Sure. Thank you.
Thank you guys so much.